Today, we are going to talk about the upcoming project that is set to redefine District 19. It doesn't have a name yet, but let's just refer to it as Hougang Central Residences. We are tackling this highly anticipated project from every angle, breaking down the billion-dollar bidding war, the developer strategies, the massive transit upgrades, the hidden future land plots, and the vital lesson learned from past Hougang condos. Let's start with the overview of the land sale. The 500,000 square feet Hougang Central mixed-use site was awarded to the consortium led by CapitaLand and UOL Group for a staggering 1,179 PSF per plot ratio. And what makes this bid significant is how incredibly close it was. The second bid from Simlian Group came in at 1,155 PSF PPR, and that is a really close gap of 2.1%. When two massive developers agree on a price gap of 2.1%, it means that the downside is structurally protected by the industry's own internal valuations. And for a site that holds a lot of transformation potential, a margin that's this tight is a powerful signal. It shows that top developers share very strong mutual consensus on the exact valuation and massive potential of this specific location. And just to give you a sense of where the launch prices are going, Parktown break-even was 1,661 PSF, which became an average 2,360 PSF at launch. Pioneer break-even was at 1,823 PSF, which became an average of 2,546 PSF at launch. So Hougang Central Residences with a break-even of $2,059 would likely have an average of $2,700 plus PSF at launch. And these are just based off the numbers. There is no actual launch data or indicative sales info at the moment. And if you would like to be updated on this, drop me a text at 9697 1000. And today, we are going to be using Parktown as a comparison here because both have similar land sizes and plot ratios. Parktown has approximately 146,000 square feet of commercial space, while Hougang Central is going to have over 430,000 square feet of commercial space, which is almost 3 times the size of Parktown's commercial space. And just to give you a sense of how big 430,000 square feet is, it is almost 2 times bigger than the existing Hougang Mall and even bigger than Waterway Point as a comparison. And so this is gonna be a huge mega project based on just the commercial space alone. Parktown Residences houses 1,193 residential units, while Hougang Central Residences would likely house over 800 units. So I guess that's where the extra spaces went, seeing that both land plots are similar with the same plot ratios. And so now the question is, who exactly is building this masterpiece? The winning consortium is made up of CapitaLand Development, UOL Group, Singland, and King Leong. Why did they team up and who are these smaller players? First, let's talk about Singland, which is actually a subsidiary of the UOL Group, and the other small firm, which is King Leong, is the private real estate arm of the Wee family, who also controls UOL. So essentially, this is the UOL ecosystem teaming up with CapitaLand. They joined forces for 2 main reasons. Firstly, sharing the massive financial risk. A $1.5 billion land cost is an immense capital outlay, and forming a consortium is a strategic way for developers to pool together their resources and mitigate risks. And the second reason is the unmatched team synergy. This exact same partnership recently launched Parktown Residences in Tampines, selling 87% of its 1,193 units on launch weekend. And furthermore, CapitaLand will also retain 100% ownership of the commercial component because they see Hougang as a highly populated but severely under commercial retail market, and by controlling the 430,000 square feet more from day one, they can perfectly create the tenant mix. And when we say highly populated, here are the population charts by estate. Hougang is trailing behind Bedok and is top 10 populated HDB districts in Singapore. And now moving on, the absolute game changer for this plot is its transit integration. Hougang Central Residences will sit directly above the Hougang MRT, and right now it serves the Northeast line, which is the purple line, which acts as a fantastic north-south transit, bring your residents straight to Dhoby Ghaut or to the CBD. But the real magic happens in 2030 when Hougang becomes an interchange for the Cross Island line. And this Cross Island line will act as a major new east-west line, and this dual connectivity combining with a mature north-south line will give this plot virtually unparalleled accessibility moving forward. And to touch a bit on this Cross Island connectivity, this is going to be one of the rare few OCR projects with an interchange like this as part of Singapore's decentralization strategy. All these talks of future developments is great and all, but why did these huge developers actually bidded casually and upward of 1 billion here? The strategy secret is that Hougang Central Residences site is actually one of the 3 large plots designated for housing around Hougang MRT. And this isn't the latest news. In fact, the government foretold of this trilogy happening here since 2024 and clearly demarcated the land and also the approximate sizes of these plots. But why aren't the other 2 plots being released now? The authorities are likely delaying the release of the remaining 2 plots because the land is currently needed for the existing infrastructure and ongoing Cross Island line construction. Specifically, the land is tied up in the first one, the bus interchange plot, which is a roughly 3-hectare plot situated just south of the new mixed-use development site and is currently occupied by the existing Hougang Central bus interchange. And then we have the next plot, which is the Cross Island construction plot. The larger 4-hectare plot is located even further south, is presently used for Cross Island line development works. And because Cross Island line is still actively being built, we can expect that the authorities will only release these sites for sale or development after real construction is finally completed. Strategically, this also makes financial sense. By waiting until the new MRT interchange is ready and operational, which is expected to be around 2030, the expected transport infrastructure will increase the overall value of the land. And depending on whose side you're on, it will be good news for the government and also the people who buy into Hougang Central Residences, but bad news for the people who didn't manage to get a unit over there. And if we as consumers can see this unfolding in front of us, that this has definitely been spotted by the developers and they are going in for the first mover master plan. By bidding aggressively for Hougang Central Residences today, CapitaLand and UOL are locking in today's land prices rates first. By the time the remaining plots are released in 2030, the MRT interchange will be fully operational, meaning that the land values and subsequent property prices will be significantly higher. Whether UOL and CapitaLand would want to own a monopoly on the remaining land plots remains to be seen, seeing that the other plots are likely to be over $1 billion or at least close to it. But in the meantime, that gives Hougang Central Residences a 5-year head start window to dominate the market before any other competitor can break ground here. And one of the biggest questions we have is how will this development be received? Seeing that it's going to be the most expensive OCR integrated development so far. And to gauge how buyers will react to new launches here, let's take a look at Hougang's last mega launches, which is Riverfront Residences in 2018 and Florence Residences in 2019. Both have over 1,000 units and are doing well since post-launch and resale, aggregating approximately 30% price growth over the past few years. But wait, these condos are nowhere near the MRT, so why did they outperform older condos which are closest to the MRT station? Part of it was the attractive initial launch price. The Florence Residences launched at around 1,400 PSF averagely, and Riverfront Residences launched at around 1,200 PSF. Back then, if you are a resident in this neighborhood and were looking to upgrade, you will realize that you only have either old condos to choose from or move downwards to Kovan, which has newer condos, but it is a different neighborhood and, if I might say, pretty expensive prices overall. Hence the attractiveness of Florence and Riverfront Residences back then at launch. Hougang is also home to Holy Innocents and CHIJ OLN, which is Our Lady VT or something like that. Two popular schools in the heartlands, and as we've seen in major neighborhoods, families tend to build around an area with multiple schools, and even more so when there are branded ones over there. And perhaps, or maybe I'm thinking about this too much, the deeper reason for this success and the demand of this estate is perhaps what we call maybe the Hougang spirit or the district loyalty. Hougang is known to be a massive family-oriented homestay market. HDB upgraders here don't want to leave their neighborhoods. And when they upgrade, seeing Riverfront Residences and Florence Residences, it does seem like they prioritize large modern facility-rich environments with massive pools and hundreds of facility zones rather than being right next to the MRT. The success of these projects prove that the district is incredibly loyal and hungry for large-scale premium living. So with Hougang Central Residences now offering unparalleled accessibility but almost at 2 times the prices of the previous launches, will the Hougang spirit or district loyalty still hold up? And not every Hougang condo is a winner, even those closer to the MRT, like Midtown Residences, a mixed-use project. This project serves as a crucial cautionary tale, previously ranking among the condos with the most unprofitable transactions in the Northeast. So why did Midtown struggle? Number 1, the wrong unit mix. Midtown heavily featured 1 and 2 bedroom shoebox units, and because Hougang is dominated by families and HDB upgraders, the shoebox units face very limited resale demand. And number 2, they had very unfriendly floor plans designed for families. Imagine upgrading from a HDB to this 689 square feet 3-bedroom unit. And that's right, you didn't see the size of the unit type wrongly. And if you thought these 3-bedroom floor plans were bad, even the 2 bedrooms just didn't feel like one, and mind you, all these were done before harmonization happened. And number 3, the fragmented retail, because Midtown's commercial component was strata titled, which means that it was sold to individual owners, leading to a disjointed tenant mix, vacant spots, and limited dining options, which eventually dragged down the property's overall appeal. Hougang Central Residences specifically dodges this bullet by having controlled 100% of that entire 430,000 square feet more. The tenant mix will be professionally curated and vibrant from day one. Additionally, the developers also know the demographics and are expected to cater heavily to efficient 3 bedrooms or perhaps even 4-bedroom family layouts. And so all in all, what does this mean for you? With an expected starting launch price between 2,500 to 2,600 PSF, what is going to be your play here? For the own stayer or the HDB upgrader, if you are a family living in the Northeast, this is the pinnacle of convenience. You will get a massive mall that is bigger than even Waterway Point, a bus interchange, 2 MRT lines right downstairs, plus proximity to elite schools like Holy Innocents Primary. But the huge downside will be the pricing for these units. A 3-bedroom will likely exceed $2.5 million based on the rough PSF we are calculating. So you will need to ensure that your finances, your CPF, your TDSR limits are rock solid, and also make sure that you're okay with the monthly installments moving forward. And also this area would likely have some form of construction upon TOP because of the 2 land plots in front of you. They will likely launch after the construction of the Cross Island line, which means that when you get your keys, they may have started construction for the 2 other residential plots. And for the investor, if you want to buy here, you must play the long game, because you will be paying for future prices today, and this is absolutely not a short term flip. The real investment play here relies on holding on a longer horizon of 7 to 10 years. You will need to hold it through completion and wait for the Cross Island line to officially open in 2030. This is when you'll see the massive price growth from the new interchange, the Cross Island line being ready and functional, and the huge 430,000 square feet of commercial space. And the price growth will grow even more when we are talking about the future land sales of the 2 remaining plots from from 2030 onwards, and even if you're holding on past into their potential resale in the future as well. And so in summary, Hougang Central Residences isn't just a condo, it is likely going to be a generational shift for the Northeast. It capitalizes on incredible transit upgrades and avoids retail mistakes of the past, and also taps into a fiercely loyal buyer base. So what do you think? Will this integrated development be sold out like what we've seen in Pinery or Parktown Residences? Or will it be a development that is too far out of reach for the organic demand in the area? Will you be ready to pay for the premium for ultimate integration? Let us know in the comments below. And if you like videos like these, don't forget to subscribe to the channel. I'm ASAP and I will see you in the next video.